Hello, and thank you for joining us. My name is Scott Rickard. I'm the Chief Investment Officer of Granite. This is a series of presentations we've put together for our clients to help them have a better understanding of the benefits and risks associated with investing in non-performing loans. Today, to talk about the pricing of loans and how we look to structure the loans, we're here with the senior analyst, Anand Narayanan, to talk about how we price our loans. Thank you for joining us today, Anand.
Thank you very much.
Anand, can you give us a little bit of background about your experience and your background?
I began primarily as an engineer. That's how my career began, specifically in the electronics engineering space. Spent about 5 years with Hewlett-Packard before I gravitated towards capital markets and finance. And I was always interested in applying some of the knowledge that I had picked up during the engineering days to the financial engineering space. And so decided to pursue an education in capital markets and international finance. Once I completed my postgraduate degree, I joined Lehman Brothers with the Asia trading desk in Tokyo, dealt with program trading and some fixed income trading, learned about structured credit and all the other nice derivative aspects of the business that we've all come to know about so affectionately. And finally then transitioned over to the mortgage business and focused my attentions on secondary marketing side, primarily on the securitization of residential loans. Took a lot of what I had learned from my previous work experience, both with Lehman and with Hewlett-Packard, and came up with designs and structures for asset-backed securitization. And finally, that culminated in a meeting with Granite Loan Solutions or Granite Investment Group about 18 months ago. And since then, it's been a good partnership that we've forged in terms of what I offer in terms of my skill sets and what Granite needs.
I know certainly when we met you, one of the things that was very attractive to us is you were working with a lot of local and regional banks and helping them with their loss mitigation strategies and analyzing the risk inherent in their loan portfolios, and that was one of the things that was attractive to us, as well as frankly the systems that you created to help analyze that risk was an important factor for us making that decision. Can you describe for us where you think the non-performing market segment is today?
Well, if I were to describe it in one word, the best word that comes to my mind is a displaced market segment, and what I mean by that is the market itself, the non-performing note segment, specifically the residential note segment, we've seen a displacement in terms of the price and the risk relationship that is involved in it. Conventionally, if you look at bonds and stocks and so on, you would have a theoretical relationship that sort of portrays itself into the market in terms of what you see practically. You have forwards versus futures, you have bonds, and basically the cash flows associated with bonds and how they are priced as of their face value. With respect to notes, what has happened is that relationship has sort of fallen out of sync, as you might say, and a lot of it has got to do with the inherent lack of knowledge of how to handle it in certain segments of the market, and sort of a skewed spectrum of knowledge in terms of the assets. You have the institutional players who know what they're dealing with, and then you have the one-off traders and the investors who really don't know how to put their hands around these investments and how to make money out of an investment in a particular asset like a non-performing note.
Anand, can you kind of go into detail as an example you've talked about the analysis you've done? In order to go from an appraisal to a future predictive analysis, you must be drawing on outside data to help you quantify that. Can you kind of talk about what outside data you're calling upon, and also then the other data points that you're looking at and evaluating?
Certainly, the model needs inputs, and these inputs are periodically refreshed. And when I say inputs, is basically data that we absorb from the market to make a decision. One such data that we use on a regular basis is Federal Housing Finance Agency's House Price Index, which is basically price trends at different MSAs and zip codes, if available, of property prices over the years. And this is published every quarter. So we consume that data. We also look at unemployment rates by county. We look at interest rates that is supplied by Moody's. It's sort of a forward projection of the key indices that we look at in mortgages, like the LIBORs and the treasuries, and the 5-year, the 10-year treasuries. And sometimes what we do is we also look at appraisal data as a look-back factor. Appraisal data that we get from BPO vendors as a look-back factor to fine-tune our models on an ongoing basis.
Okay, great. I notice as well that you're doing analysis on a loan level basis. And I think that's critical to make sure that, from a standpoint of buying from the banks, that your loan level evaluation. Can you kind of talk about what the banks appreciate or the clients appreciate about this modeling?
It's an interesting point, Scott. I mean, I think what we term it as in the risk management world is called the basis risk, is when you are pricing it based on portfolio level value vis-a-vis loan level value. And a lot of banks appreciate that, you provide them with a pool level bid at the end of the day. Now, it does matter, it definitely does matter how we arrived at the pool level bid. What we do is, the pool level bid is essentially the accumulation or the average of the loan level bids, the weighted average loan level price points that we determine. The banks use that in terms of understanding what we price and how we price. It enables us to establish a dialogue when we are going through a bidding process. And what it also does is it makes it easier for us to determine which of these loans makes sense for us as a business, what doesn't, so we price it accordingly. And as far as our end consumers are concerned, since we are actually pricing each of these loans at the loan level, at the asset level, it helps us deal with them in terms of negotiating price points and making them understand that there are returns to be made even with margins added, as far as we're concerned.
And I think one of the important things to know about Granite's whole business strategy, our strategy is not to hold loans for a long period of time. We're a trading platform. So our objective is to buy loans from the banks, repackage those loans, and immediately get those loans back out to the marketplace with a new set of eyes, and again, to the best of our ability, to local buyers that have the best understanding of those markets.
That's great.
And I think our objective in our pricing as well is to price our loans when we sell. Fortunately for us, it's not a bid process where somebody comes in and has to outbid someone else to win the deal. It's a negotiated process. So we lay out the information, we lay it out for people to look at and understand. They can then come in, and based on that, they can get on the phone with our traders, and they can negotiate a price. And if they negotiate the price, they win the deal, and they have the product. And I think that's one of the important things that we're dealing with. So our goal and objectives from the time we buy from the bank and repackage is to within 60 days have that information sold. And so again, we're focused on a high velocity model. When you're talking about the number of loans that are processing through Granite at this point, how are you keeping up with that volume?
Most of our processes are automated, from pricing to our acquisition models to our inventory management system. We have a very good handle over it because we have very well defined processes in terms of even loan status management. From the time it arrives at our door, it goes through multiple status changes before it hits the market as far as our buyers are concerned. Now, tracking those loans would become a challenge because you're talking about large volumes like you suggested. So we have put into place very good flowcharts and workflows that make sure that every loan falls into one bucket or the other. You won't see a loan disappearing into a black hole and then appearing a few months later. I mean, I'm stating that because it has, in my experience, happened in previous places that I've been with.
Well, we feel every loan has a price at which it will go out the door and sell.
That's correct. Every loan has a price. Every loan has a status. So tracking the status and eventually looking at loan level profitability, looking at loan level execution strategies. Now, since we are a velocity player, we have to automate most of these processes, and of course not lose the personal touch we have with our end clients. That's where I think our traders play a phenomenal role in terms of keeping that personal touch with our buyers so that they can pick up the phone and call us if they have any questions about how a loan is valued or why they're paying an X amount of dollars on a particular loan.
Well, and I think one of the things too that I found to be very interesting in the business strategy, and it's really Jeff's vision, having been a trader on the other side of the table, is we have, it might surprise people, but we have actually held the limit on what we'll sell a property for, because we understand that, as an example, if you're going to implement a foreclosure strategy, and in that particular state that you're buying that property, the foreclosure may take you 60 days, It may take you 18 months. And in either case, you need to price in and understand those costs in that market. And so we know those costs, and we can help price that in so that when somebody's buying a loan from us, we can price it so that they still can recognize that exit strategy and make a profit at the end.
Precisely, and I think that's the biggest benefit as far as our end clients are concerned is what is stopping a lot of our clientele or potential clientele in the market is the knowledge or the degree of separation from taking the note and making it into an investment that is profitable. You know, how do you take it from one point A to point B? And through our education programs that we are conducting on the webinars, and also with the fact that we lay out clear-cut paths to profitability, and what are the costs for every one of those paths that you would take, and essentially how that rolls back to the price that you're paying today. Why, even after, despite all those costs and the timeline that you add on to it, that every one of those investments at the price point that you're buying it at from us makes it still a profitable venture for individual asset buyers. And that the same applies for bulk players as well, coming in and buying it at, there's obviously a different play when you come in as a bulk player. Again, you're looking at slicing and dicing and stratifying your pool. But again, with the price points and understanding the cost elements and taking that degree of separation and narrowing it from buying an asset to making it a profitable investment, that's where I think Granite has a unique strategy of educating our buyers and holding their hands to that from point A to point B.
Well, I think it's important for people to take advantage of the resources that we've created by going to our website, going to our Knowledge Center, and being able to view the different seminars or the different presentations or the different industry expert presentations that we have up there, where we've had an opportunity to interview different loan servicers and the different strategies for exit strategy, and help have a better, like you said, educate the buyers as to how to create the opportunity. We want to make clear that this is not an investment sector without risk. If you've got a collateral that's declining in value, you need to take a strategy that's going to help you do that. And I think certainly through the training that we have on our website, we certainly help people understand the strategy they need to do in order to make a profit.
The fact that we're dealing with non-conventional assets, these are not bonds that you can buy off, and they're not liquid assets, as you might say, but that in itself is an opportunity more than a threat, because equipped with the right way to handle it, equipped with the way to understand how to handle a particular unknown element within these, the unknowns specifically go away when you start to understand the risks that contribute to it.
Right.
And when you take that and you run along with that from point A to point B, there are specific decision nodes, and it's like a big decision tree. And if you can follow any one of those paths in this decision tree, it is going to help you make money.
Well, again, I thank you for coming today, and thank you for participating in this. I think what we'll need to do is we'll kind of wait and see what kind of reaction we get from our clients, and we may want to do a follow-up presentation where we get into greater detail in analyzing the modeling of how we do it. Certainly Monte Carlo is analysis is a new element to some people, understanding how you quantify the risk and look at a statistical evaluation of the pricing. So we'll certainly see what kind of reaction we get from our client base, and we may need to go into a greater detail in a future presentation.
Oh, we look forward to it.
In the meantime, I would certainly encourage people to go to our website. I would encourage them as well, talk to their legal counsel, their legal advisors, talk to their accountants, understand the risks associated with this business. And if you don't have the proper counsel, we can certainly direct you to people on our website that have access to the right people in those markets. Third-party people that are unaffiliated with Granite.
Certainly.
That can help advise them on the risks and the rewards of this business. So again, thank you for joining us today, and we appreciate it.
It's been my pleasure. Thank you very much.
You bet.